out an optimistic scenario. Let's say Omicron is the last variant and COVID begins to fade from being a pandemic to something more manageable. You're going to see a couple things happen. You're going to see an acceleration and improvement in the supply chain. So you'll see more goods coming in. You'll also see a shift in demand away from goods towards services and experiences. So you could actually see goods deflation by the end of the year. And that would give the Fed a lot more leeway to manage this interest rate hike, this shift in Fed policy.
So what's the challenge that Fed officials have in front of them today, Tuesday and Wednesday? And how do they talk around this?
Well, I think they have to stay committed to the bond buying is going to end by March, and interest rates will start to begin rising. And I think they're going to telegraph that very clearly. I do not think you're going to get a dramatic shift from that scenario, because I think that would put more fear into the market. I also don't think you're going to get anything more than a quarter-point rate hike. But you can't rule out if inflation continues to get worse and gets out of control. You can't rule out a half-point hike, right. But we don't see that.
What do you make, though, that we're seeing this trade before we get a Fed decision on Wednesday? That's what I don't get. I really thought we'd be marking some time, and maybe that's what we get tomorrow. But how do you square that, what we're getting today, with what maybe there are some unknowns in terms of what the Fed may throw us on Wednesday?
Well, I think this move, not only today, but in this month so far, has really been a reaction to the shift in Fed policy that is coming down the line. And perhaps, the market is an anticipatory vehicle. And when we get to the end of bond buying and the beginning of rate hikes, we will have already had the sell-off. So that's our thinking right now.
Right.
And we don't think we're going to get any surprises in terms of verbiages from the next Fed meeting.
All right, we got to run. Hey, Hank, good to check in with you. Hank Smith, he is head of investment strategy at Haverford Trust, based in Radnor, Pennsylvania, and that's where we find him on the phone on this Monday. Just a few minutes left in the trading session, and we are in the green across the board.
Yeah, you're eating mashed potatoes.
I'm eating mashed potatoes. Remarkable, and I still do find it remarkable ahead of a Fed decision that we'll get on Wednesday, but it just shows that investors saw this as opportunistic and came in and did some buying. All right, folks, we're going to be joined by our Bloomberg TV team for Beyond the Bell, live on radio, TV, and YouTube. We're counting you down to the close on this volatile Monday.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day, a wild day. Romaine Bostic, Caroline Hyde, Taylor Riggs counting you down to the closing bell, here to help take us beyond the bell. It's our global simulcast partners, Carol Massar and Tim Stenovic, bringing together our audiences across Bloomberg Television, radio, and YouTube. A day that started off with pretty much a plunge all the way down to the depths of correction for the S&P, the NASDAQ, the Russell, and everything in between. 1,000-point drop on the Dow Jones Industrial Average, Carol. But here we are right now, everything in the green. Where are your mashed potatoes?
I'm going to be eating mashed potatoes. I am shocked to see the investor buying, and we're seeing broad-based buying into the close, especially when you've got, Tim, that Fed decision come Wednesday. I'll get my mashed potatoes, but I'm still waiting to see what the Fed has to say.
Look, earlier in the day, the narrative that we were hearing was, okay, investors perhaps taking a step back and thinking about what happens and waiting to hear from the Fed. But hey, they'd rushed in and they bought that dip. The NASDAQ 100 up more than 5.6% from lows right now.
I thought a 4-day week last week was pretty long. I mean, this feels like 5 days in one day. Extraordinary. And, I mean, does this mean Jay Powell can relax now come Wednesday? He doesn't have to worry about what the market's trying to signal to him?
Well, the market's certainly on the long end, Caroline, signaling the 10s, 20s, 30s yields. They are rising. If that's an indication of how we're thinking about growth and inflation on the long end. And the 2-year yield is only down 4 basis points to just 96 basis points. A 5-year yield, mostly unchanged.
And I just want to point point out, we've been talking a lot about sort of the trading range on the S&P 500. Right now, we've swung from peak to trough by about 194 points on the S&P 500. We talk about how that compares to the swoon in March 2020. 219 points. That was the biggest day that we had. That was March 13th of 2020. So we're not far off that in terms of the severity of the swing here. Of course, the severity this time, unlike March 13th, 2020, is we're going to end positive, believe it or not. The S&P 500, and we're going to take time to walk you through this, folks, because this is important. The S&P 500 was down 4% on the day. It's going to close higher by 13 points, or about 0.3%. The Dow Jones Industrial Average was down more than 1,000 points. It's going to close higher by 100 points, 0.3%. The Russell 2000 was down more than almost 3%, now going to close higher by 2.3%. And let's flip it up to the NASDAQ indices. Both the composite and the NASDAQ 100 were down almost 5% on the day. They're both going to finish in the green. The NASDAQ composite higher by about 0.6%. The NASDAQ 100 higher by about 0.5%, Caroline.
Yeah. Well,
Carol, guess what's in the green? ARC Innovation ETF.
See?
By 2.8%.
You know what?
That's
She's back.
significant.
You know what's
Back.
remarkable about that, Caroline, is it hit a new 52-week low today. Just today, hit a new 52-week low, and now it's closing in the green.
Extraordinary.
Well, and what's interesting, Hank Smith of Haverford Trust was just on with us, and he said, listen, we've seen this technical correction. Certainly we saw it on the S&P 500. We've seen it in small caps, and at this point, investors are seeing opportunities. He used the word Tina, saying there is no alternative. What are you going to do? Buy the fixed income market? You're going to buy treasuries? You still have some outperformance in terms of the equity.
In fairness, people did do that earlier today.
But look at how but look at how quickly they swung and walked
your
away
point is
from
taken.
it.
Yeah, I'm just being cheeky.
I know you are.
Oh, cheeky.
Well
Romaine,
done,
your
well
favorite
done.
word. Let's come
some
back,
mashed
Carol, and just
potatoes for you.
dissect some of these equity markets for you. I know that we're also focused on the bond markets as well. Just from a sector level, this is a level 2 of the S&P 500 that we're talking about. This green was a lot more red than it was before the market closed. It is basically green in the green and red in the red. But the composition is really interesting because you're getting a mix of this. You're getting energy, but you're also getting food and staples. You're getting transportation, but you're also getting consumer durables. So you're getting a pretty broad range of the sectors, at least, that are in the green here. I'll bring you down to the red because the red still is pretty significant. A lot of this is food and beverage, but it's autos if you're thinking about the risk taking, and utilities if you're thinking, Carol, about those bond proxies as well.
Green in the green, red in the red. You paint a picture, Taylor. Meanwhile, we're going to get more, sort of trying to pick apart these extraordinary moves on the day. Let's get you an expert. Ed Clissold, Chief U.S. Strategist for Ned Davis Research. Give us your viewpoint. What happened? Why did the dip buyers suddenly come back around lunch?
Well, I think there's a few things. One is that clearly the hedge funds were net short. Looks like there's some short covering there. Then you throw on the algos who come in toward the end of the day. They do a lot of their trading the last hour, last 30 minutes. And so when the momentum got going to the upside, they added to it. But also, our sentiment indicators were showing the market was getting pretty washed out short term. So any sort of positive news was going to probably followed up with a bounce.
Well, let's put this into perspective here, Ed, because last week you guys over at Ned Davis, and you guys do some great research, but you kind of put out a call here that kind of the best was behind us. And forgive me if I'm mischaracterizing it, but there was a general sense here that not only were we headed towards a full-blown correction, but there actually needed to be a little bit more of a shakeout in this market, primarily because of what we've been seeing or maybe not seeing this earnings season. Do you still stand behind that?
Yeah, we do. So the call from last week was really looking out a few months, really through the first half of the year, and saying that not necessarily we're going to have a major bear market, but the pace of gains are likely to slow, and you're going to get more corrections and more volatility, which of course we've seen over the past week. But one of those big concerns was that the remarkable earnings growth stories that we saw last year are probably made very difficult to replicate this year. During each earnings season last year, you got massive upward earnings revisions, great beat rates, or percentage of companies beating estimates. So far, we haven't seen that. It's early. Only about 12% of S&P 500 companies have reported. About 75% of them have beaten estimates. That sounds great. It's not bad. But last year, each quarter had over 80%, and we're approaching 85, 86% some quarters. So it's just not quite as good as it was before, and that probably will lead to more modest gains and bigger corrections.
Well, and Ed, what do you think is the biggest determinator in terms of where we go next on the equity trade? Is it the technicals? How closely are you watching that? Is it what we get in terms of earnings and more particularly outlooks from these companies? Or is it Fed policy ultimately, or a little bit of everything?
Yeah, it's going to be a little everything, but if I'm going to pinpoint one, I'll go to the Fed. You know, this bull market was born of the Fed and their extraordinary measures, and it will probably die at the hands of the Fed. So we'll get a much better idea on Wednesday what the Fed is thinking. The market has moved from, you know, maybe a couple of hikes in 2022 to now calls for hikes every single meeting in QT. And so all that angst has probably added to the consternation over the past several days. Moving forward, maybe we'll have a little bit better idea of what the Fed is going to do. And then to take it one more step further, as we go out a few more months, we'll probably get a better idea of what inflation actually is going to look like this year. And that may give the Fed room to go a little bit slower than some are fearing the Fed's going to have to do.
And how do you balance then the higher yields, the research that you've done, the impact on lower net present value, with the alternative that we heard from Jeremy Siegel, professor over at Wharton School, with sort of Tina? There is no alternative. In the long run, equities are the inflation hedge. How do you balance that with what could be lower net present value?
Well, I think if you're looking at over the next few months or even about to a year, the speed of the interest rate changes really matter. So even if you go post-financial crisis, interest rates were low throughout the entire time. But if you got a spike higher, 100 basis points in the 10-year Treasury over a few months, the stock market took notice. So there's that aspect of it. Over the long run, if interest rates do remain low and the speed is modest, if we have a slow move higher in interest rates, stocks will probably do fine. For example, from the early 50s, when interest rates first started to rise, and went all the way to 1966, 15 years of a slowly rising interest rate environment before rates got high enough that was a problem for stocks. We probably won't have to go 15 years this time, but it does tell you that the market can work higher if yields are rising, as long as it's not too quickly.
Ed, help us understand what investors should be looking for from commentary from companies. We're about to be in the midst of earnings season. IBM today. Later this week, we're hearing from Microsoft, Tesla, and Apple, of course, just to name a few. What do you want to hear from these companies to tell you what the pulse of the U.S. economy is and the world economy and the consumer?
Yeah, I think we're going to need to hear a lot about Omicron and supply chains. But then the other thing I'm going to be listening to very closely are wages. That's going to have a big impact on the Fed. If we get wage push inflation or employees demanding higher wages because they think prices are going to rise for them, that's going to be a bigger issue. But also profit margins were a big driver of those remarkable earnings gains last year. Usually in the third year of an economic expansion, which we're going to be in for most of this year, margin expansion continues. But because we've already done such a good job on the margin front, if wages are a little higher, I wonder how much more margin expansion is out there. So wages and costs on that front are going to be key.
I'm interested in your take quickly, Ed, on retail versus institutional right now. How much do you think is big? You'd say it's the algos that dictate trade. How much does retail really hurt?
Yeah, there are probably a lot of people who were new to trading, learned a lot of lessons over the past few weeks. So that may take some of the froth out of the market. Although institutions are probably taking their lumps as well. But it's quite possible. We've seen the peak of the Reddit group. We'll have to see how well they come back.
Ed Clissold, Chief U.S. Strategist for Ned Davis Research. Really appreciate the perspective here on days like today. Caroline, some breaking news as well on fundamentals.
Yeah, IBM coming out, and it's a beat with its fiscal fourth quarter revenue, $16.7 billion. The estimate had been for $16 billion. They're saying that is growth of some 6.5%, 8.6% if you're factoring in constant currencies. We're also seeing consulting revenue looking pretty healthy, $4.75 billion. This is revenue up to the tune of 16% in a constant currency basis. Software revenue, this is where all the analysts' eyes are trained. Software revenue, $7.27 billion. This is up, 10% at constant currencies. Remember, this is all as they've taken out Kyndryl, taken that bit out of the business and really doubled down on what is the future of cloud, of software, of consulting. Anurag Rana is with us, of course, Senior Software and IT Service Analyst for Bloomberg Intelligence, joining us on the phone. And dig into it with us, will you, for a moment, because this is what Arvind Krishna's been talking about. He's been promising mid-single-digit growth, right?
Yeah, no, absolutely. So the two things that stand out to us is consulting growth and the improvement in software. And these are the two areas where, going into the quarter, we expected the consulting to be strong, but we weren't sure where the software is going to end because last quarter they had a blip in software. It's nice to see a recovery in that segment also.
Talk to us a little bit about the legacy business. We see that go down, and I think that would be a good thing. This is the infrastructure business. It looked like it's down 2% here on a year-over-year basis. How is the runoff of that going relative to the uptick that we're seeing with regards to software and other services?
So the infrastructure segment will go up and down, and that's cyclical, as well as there's not going to be that much growth in that in any case. But the real kicker is, how is software going to go going forward? I think the guidance that we're going to hear on the call is the most important thing for the company at this point, because software not only brings good revenue growth, but it also brings really high gross margins, where gross margins in software are close to 80%, where that in the infrastructure segment is only 50%, and while in the consulting segment is only around 30%.
Anurag, this is a company that has been kind of setting itself for the future, right? Selling off some units as of late. How nervous, though, are you that it hasn't put out an outlook, that it's going to talk about 2022 expectations on the call? What does that say to you?
I think, if you look at it from a macro point of view, technology spending is strong. It's actually very strong right now. It's one of the best that I have seen in the last 15 plus years. So from that point, we see no reason why IBM's consulting growth should not continue into next year, and so same thing for the software group. But we don't know what kind of margins that brings with us at that point. So I'm frankly not that concerned about the growth aspect. But one thing that I would say along with it is IBM still has a long way to go before it can match its peers when it comes to overall growth rate.
All right, Anurag Rag, I really appreciate you taking time to be with us, Senior Software and IT Services Analyst at Bloomberg Intelligence, breaking down IBM earnings for us. IBM shares higher by about 6%. The headline, Taylor, is IBM posting its best sales growth in 10 years on cloud demand.
We take a look at fundamentals from some of the individual companies and fold that into fundamentals of some of the markets that we got today. Let's do all of this with Gina Martin-Adams, Chief Equity Strategist for Bloomberg Intelligence. And Gina, you just heard Anurag talking about some of the companies, some of the big tech companies we're starting to hear from this week. You fold that in to a tech sector that managed to close up 0.6% today, Gina. How are you thinking about the fundamentals in this equity market?
Yeah, so frankly, the fundamentals have been somewhat ignored as the market has been very much focused on monetary policy and what's going on in rates and duration as the primary factor really driving stocks over the last couple of weeks. So getting into the thick of earnings season should provide some degree of welcome reprieve for the equity market. In particular, this week of earnings, we get the most S&P 500 companies reporting this week. We get all of the giants in the tech space, Microsoft, Apple, as well as Tesla. Next week, we'll move to communications. So provided that these companies can be like IBM and beat expectations, and importantly, if they can guide for better growth going forward, in particular on the margin lines, it could provide a welcome source of stability and some reprieve to the endless selling that we've been experiencing for the last couple of weeks.
The flip side of that is we see another situation like we saw with Netflix Thursday after the bell when Netflix reported. Gina, you have a new note out from you and your team this morning. It's saying that
through to the bottom line. So the companies do need to manage costs really carefully. They need to convince the consensus that they're going to be able to do so going forward. And they might be able to produce a little bit of share buyback upside to EPS as well. That could certainly improve the outlook.
Is there going to be a difference this time around, Gina? And we're in conversation right now with Gina Martin-Adams, Chief Equity Strategist for Bloomberg Intelligence. Is there any sort of difference this time around, this earnings season and the earnings seasons the next couple out, where when we talk about cost cuts and whether it's just, slashing the number of folks on your workforce or trimming some other costs around the edges, that's going to be sufficient enough given that so many of the cost pressures, upside cost pressures, are coming more from the supply side this time than on the demand side?
Yeah. No, what they do need to do is give us some confidence that the supply chain constraints are going to ease. I mean, frankly, the little minor cost cutting around the edges is not going to be enough to produce that sort of really significant change that I'm talking about. What we need is some resolution of supply chain. And this is what makes this such an uncertain environment, is supply chain has been a huge part of the cost pressure. We also, I think, need a little bit of confidence that wages will not get out of control, that sort of labor force movements are not changing dramatically. We saw some weakness evolve in the financial sector as a result of some of the JP Morgan comments about wages and sort of the stickiness of labor. So I do think we'll have to get some confidence out of tech as well, because labor is a very big part of their input.
Well, Gina, just to follow up on that, I'm curious about the supply chain side and the commentary that we're starting to get now out of some of these companies, particularly as we get into some of the more consumer-facing companies here. So far, we haven't heard a lot of companies say that things are better, or at least not dramatically better here. What are you expecting to hear going forward from some of those consumer-facing companies?
I think it's going to be a lot like what we heard in the third quarter, which is not yet. And that was unfortunately a little bit disappointing for the market, which was expecting by the end of 2021, we would ultimately have resolution to the supply chain constraints. But largely due to the Omicron virus popping up, really taking the sort of supply chain consensus by surprise, we have this sort of extended supply chain weakness. I think we want to hear from the tech companies how they might be considering about contending with this longer term. And what I mean by that is this is a space, and the market at large has been caught in this trap of very, very low capital spending, sort of really, really constrained spending growth for a long period of time. One of the big upside surprises I think we might start to hear, and we did start to hear this in the third quarter, is companies actually coming back to market, spending money to improve the supply chain dynamics, spending money finally on CapEx, ultimately feeds through to better growth longer term for most sectors and industries in the economy. Companies are still sitting on a lot of cash, and investors are going to want to know what they're going to do with that cash. Are you going to spend it on buybacks like they did in 2021? Or are you going to continue to start to really edge back into spending it on capital spending? Because that has much stronger positive impacts throughout the entire tech, industrial, even materials complex of the world, which could provide us with some degree of upside. I think on supply chain, if all you're going to do is sit around and wait and sort of navigate around the edges for things to go back to normal, I'm not sure the market is going to be terribly happy with that response.
The market waits for no one. Gina Martin-Adams, always great to get your expertise on days such as this, Chief Equity Strategist for Bloomberg Intelligence. Carol.
All right, that's going to do it, folks. What a day, and we'll see what tomorrow brings, whether or not we see a continuation of the move up or whether...
Enjoy your mashed potatoes.
There it is. I was waiting.
Everybody's waiting for the video. Oh, man, not fair. All right.
Photo or it didn't happen.
Exactly. All right, we're going to catch you again, same time, same place tomorrow on radio, on TV, and on YouTube for our cross-platform coverage. This is Bloomberg.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
The Bills and Chiefs game. Can I just put that out there? I mean, it was just like back and forth, the volatility.
There were a lot of jokes this morning about coin tosses and markets.
Oh, man. Like coming down to the wire. But to see the buying into the close again tomorrow, I wouldn't be surprised if we see just kind of some marking time, and then let's get through the Fed meeting and see what the Fed does, and also some of those big tech earnings.
What is Jay Powell breathing a sigh of relief right now, or is he like, I'm going to be asked about all this volatility? What's going on?
I mean, the volatility's there, but at least there was buying into the close rather than some selling into the close.
it's great? In just a few minutes, we're going to be speaking with Peter Atwater,
Yeah.
adjunct professor of economics at William & Mary. You might know him from coining the term K-shaped recovery.
Yep.
Interested to hear what he has to think about all this, because he sent some thoughts earlier today. And yeah, it's going to be a fun chat.
All right, first up, let's get to Charlie Pellet with a check on your top business stories. What a day, Charlie.
And I love days like, I mean, this is what we live for here at Bloomberg. What a wild session, but a mashup of a number of factors today that really affected investors. We had the Fed, Ukraine earnings. Moments ago, we did hear from IBM. Let's begin there. We'll get to the markets. You guys discussed that at length. IBM out with revenue that did beat analyst estimates, lifted by strong demand in its software unit, which includes IBM's hybrid cloud offerings, signaling that the company's efforts to transform the 110-year-old tech giant are bearing fruit. Right now, IBM shares, they are up. Let's revisit what happened today. The numbers tell much of the story. At one point, the Dow had been down more than 1,100 points, down 3.25%. The Dow ended the day with a gain of 99, up by 0.3. S&P higher by 12, up by 0.3. At one point, the S&P had been down 175. NASDAQ, what a story there, down almost 5%, ended with a gain today of 0.6%. NASDAQ up by 86 points. 10-year yield, 1.77%. Spot gold up $7 the ounce to $18.43, up 0.4. West Texas Intermediate crude down 1.4%, $83.93 a barrel. Bitcoin today up now by 4.7%, $37,010 on Bitcoin. Again, recapping, IBM shares out after the bell, up by 6.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, on a day when we're talking a lot about market capitulation and market rebounds, we're really glad to have our next guest who writes about extreme abstraction and how less abstract companies are now being taken to the woodshed. We certainly saw that in the trade earlier on. Great to have us back, great to have back with us, I should say, and talk about the market action. Peter Atwater, adjunct professor of economics over at William & Mary. He joins us on the phone in Pennsylvania. And Tim and I were actually talking about some of your writings and your observations. And Peter, you did coin the K-shaped recovery. So we really look to you as kind of where we are in terms of the market environment as well as the economic environment. What do you make of the trade that we've seen, first of all, in the financial markets here in this new year, and a day like today where it felt like everybody was throwing in the towel until like the last hour?
Yeah, so it's been a fascinating 2022, and thanks for having me to talk about it. You know, the year started, the sell-off was tax selling, then it was higher rates, then it became a slowdown in the economy, and then this week, towards the end of last week, it started to tail into, you know, the market selling off because the market was selling off. So you could feel the reflexivity, the self-reinforcing cycle begin to take hold, and I think today we saw a major low in it. But I think it's significant that this is a market that has lost its dimmer switch over the past year. You know, you look at the degree to which you've had either elation or devastation in different names. And I think that impulsivity that is there, and we certainly saw it in spades today, is something that investors need to take note of.
Peter, I'm glad you used the term impulsivity, because we like to talk to you because you talk a lot about sentiment. You study sentiment. You get an understanding for how people feel, and no question that is absolutely connected to financial markets, and we see it play out all the time. How are people feeling right now?
So underneath the surface, all the consumer confidence figures show an American household that is not happy. Not happy at all about inflation and supply shortages and the things that affect those that have not benefited from all the financial largesse that we've seen in the markets. And so, you know, I think we still have today a very extreme K-shaped recovery that is below the surface and is particularly impacting those who were the frontline workers throughout the crisis. You know, we're seeing exhaustion among nurses, doctors, teachers, truck drivers, you know, those that have supplied, you know, the infrastructure to the economy.
Right, and you talk to professionals in the healthcare industry or those who run healthcare facilities, and they say we're having trouble finding workers because people have just had it and they're leaving. In terms of, though, the markets, I feel like every day, Peter, we're thrown conflicting information in terms of, okay, Fed policy, they often get it wrong when they're raising rates, and they often end up, guiding the economy eventually, or sending the economy to some kind of recession. At the same time, we're getting a lot of market watchers saying at the beginning of a rate increasing cycle that tends to be good for the stock market, because it's a sign that the economy can take, that the Fed can take its foot off the gas pedal because the economy is getting stronger. So how are we supposed to read all these conflicting signals that are coming at us?
Yeah, so I think we need to look inside the markets a little bit, because I think in the past year, investors have missed, I think, an extraordinarily significant aspect of what was so popular, which were the things that were extremely, the stocks that, we had meme stocks and SPACs and all of these things that were very hypothetical. Mm-hmm. And I think that becomes an important aspect, because we see that typically at peaks in investment cycles, not at the beginning. And so I think
like SPACs or meme stocks, things like that.
Yes. Yeah, things that you just really have a hard time wrapping your head around as to what do those really mean. And I think that we only see that sort of psychological distance, that futuristic moment at extreme peaks in sentiment. And so I worry that many investors are thinking about the Fed hike as the beginning of a cycle, when our investor behavior suggests the cycle may have peaked already.
Okay, that's really clever.
So what does our audience of investors need to understand about what 2022 has in store?
I think that they need to recognize that if in fact the cycle has peaked, we're going to see a continued retreat from abstraction and a preference for things that are real. So value stocks initially, and then things that have real earnings and tangible assets, and what you would laugh at as sort of old style investing that was thrown way out the window when people were playing GameStop and AMC.
But I do think about something like SPACs, Peter, and I'm sure you watch this too, that if you look at some of the indexes that track SPACs, like they are way off the high levels that we saw certainly early last year. The SPAC index, I'm looking at the IPOC SPAC index, it ended up down about 16% last year. So it does feel like all of the enthusiasm for something like that, and even meme stocks to some extent, that we saw the enthusiasm wane, I feel like, as we got kind of halfway through the year or so. So have we seen some of that? How does that then impact maybe kind of where we are in the cycle? Because it does feel like some of the enthusiasm has definitely been taken out.
Yeah, so the things that are wildest and craziest appear at the party last.
Right.
They're the things that we get most excited about right before the band stops playing. And so sequentially, it makes perfect sense to me that they would then be the first to leave. There's a LIFO quality to risk-taking, where the craziest things show up last and then leave violently shortly thereafter. And I think what we've seen over the past year is those that arrived last have been the first to really experience the consequences of falling confidence.
Go ahead,
so, okay. So just looking at today alone, like I get that. But I look at a day like today and I'm still trying to understand where we had, broad-based selling, steep losses, kind of hit some technical indicators. And was it just machines that maybe kicked it over and that's why you saw the buying? Especially, again, ahead of a Fed meeting where we may get some further clarification about how ultimately aggressive the Fed will be this year, or at least in the next meeting or so.
Yeah, I think we saw a capitulation in a lot of the extreme high flyers. If you were to look at sentiment on Twitter today around ETFs like the ARC series, there was just extraordinary pessimism, and even more so, Schadenfreude. There was a tone to it that suggests that the bears were gleeful and the bulls were paralyzed, and those are the things that I look for at turning points. So it doesn't surprise me that we had a major low today. What I think is extraordinary is just the impulsivity that has gone along with it.
What is it going to take for the impulsivity to go away? What is it going to take for this exuberance to settle, to find a floor?
I think that there needs to be greater certainty in the broader environment. Political certainty, economic certainty, the impulsivity and the kinds of tensions that we're seeing behaviorally, societally fit together. There's a tension today that exists, back and forth between bulls and bears that we're seeing play out, left and right and elsewhere.
Right.
So I think that if confidence were to begin to regain itself, then you would see less volatility, both societally and in the markets.
Yeah, it's going to be something we'll certainly be keeping an eye on over the next few weeks, if not longer. Hey, Peter, thank you so much. Great to check in with you. Peter Atwater, adjunct professor of economics at William & Mary, back with us on the phone in Pennsylvania.
I always love the connection between sentiment and what he's looking at in financial markets. I mean, that's what he looks at closely. That's what he studies. That's what he has experience
And it's smart, right? Because sentiment can impact so much.
Oh, not just financial markets, but our buying and then in turn earnings and just how we're feeling about the economy.
All right, let's get back to our top business stories, and I'll look at that trade again and how we closed. Don't you feel like it was like one of the playoff games over the weekend?
That's a nice way to phrase it. And I got to tell you, going to be very interesting to see how Asian markets will react to all of this tonight, what it means for sentiment, and of course, Daybreak Asia kicking off 6 o'clock Wall Street time right here on Bloomberg Radio. A stock sell-off that at one point rivaled any of the last 2 years was all but wiped out as dip buyers emerged by the close. The latest breathtaking reversal in markets rattled by geopolitical tensions and the Fed's campaign against inflation. The Dow, which had been down more than 1,100 points, ended with an advance today of 99 points, up 0.3%. S&P up 12, up by 0.3%. S&P had been down as much as 4%. NASDAQ ended with a gain of 86 points, up by 0.6%. NASDAQ at the session low was down 4.9%. 10-year yield 1.77%. So what about the market backdrop today and what happened? Hank Smith is Chief Investment Officer at Haverford Trust. He was our guest right here on Bloomberg Business Week.
We were really spoiled last year, but at the same time, dare I say, we still believe this is a Kina market. There is no alternative because stocks still look much more attractive than bonds. Even though rates have come up, they're still, relatively speaking, very low.
And again, that 10-year 1.77%. Spot gold up 0.5, $18.43 the ounce. West Texas Intermediate crude down 1.4%, $83.97 a barrel. Bitcoin up 4.5% right now, 36,950 on Bitcoin. After the bell, we did hear from IBM out with revenue that beat analyst estimates. IBM shares, they're up after hours now by 5.9% on shares of IBM. Boeing plowing $450 million into Whisk. It's an air taxi startup with Google roots as the century-old Titan looks to Silicon Valley to expand its stake in futuristic, self-flying aircraft that may one day zip over city centers. Recapping, S&P ends a turbulent day with a gain of 12 points, up 0.3%. I'm Charlie Pellet. That's a Bloomberg Business Flash.
Still have your seatbelt on, buddy?
I do, and I got to tell you, I mentioned Asian markets tonight, but tomorrow too, it could prove to be another wild session tomorrow.
That's why we love this business. All right, Charlie, thank you so much. Well, by one estimate, the baby food market is forecast to reach more than $96 billion by 2027. Compound annual growth rate of about 6%. You know about this, right? You do some buying of baby food. Well, you don't. You know, Arlo isn't a baby.
He's not a baby anymore, but he's like he's
a toddler.
He's so picky.
Is he?
It's brutal, yeah. As a 3-year-old, it's just like, Yeah.
Just eat it.
I know. I'm like, it's delicious.
Well, it sounds like our next guest is making some delicious organic food for babies and kids. We're talking about Yumi. They, Tim, recently raised nearly $67 million from investors.
And those investors were all female. They were all female-led investors. Evelyn Roosley and Angela Sutherland are the co-founders of Yumi. They join us on the phone this afternoon. It's great to have both of you. Angela, I want to start with you here and just take us through the funding round and give us an update about where you guys stand. $67 million, it's a lot of money. You're using this to take on the likes of companies like Gerber, right?
Yeah, that's absolutely right. Hi, thank you for having me. We are on a mission to change transparency in baby food and what it actually represents and what it means, and so how nutritious it can be, and making sure it's clean of heavy metals. And so we're using this money to take on Big Baby.
So, Evelyn, come on in on the conversation, because it's a massive market. We've all been there where we're, looking at the shelves, and once you have a kid, everything you put in their mouth, you want it to be like perfect. You want to keep them safe. You want to make sure they're eating well. How did you guys approach this, and how did you know that there was a need for what you guys are doing?
Yeah, absolutely. So I guess we could start at the beginning in terms of the origin story, because that definitely informed how we built the company. So just as a brief background, I used to be on the other side of the table. I used to be actually a journalist like you guys. I was a journalist for about a decade or so, and I've been friends with Angela for years that predate the company. Angela, her background, I love to brag about her, but she's sort of this math nerd, math savant, was in a career in finance, and also worked at Toyota working on algorithms on their actuarial risk and such. And, when Angela had her first child, as friends, we were kind of nerding out on all the research that she was discovering. And there was one theme that she kept coming back and back to again, and that was the importance of nutrition and how it really does impact every prism of health, right? From neurological development, physical development, metabolic health, like even your taste preferences are largely set by the age of 3. And what impacts that is everything that you're consuming, or even in the womb, what you're getting from your mother. And so what we found so astounding was that if you can really control for the interventions, the nutrition that you're getting during these first years of life, you can really change the state of metabolic health in this country and change the state of, health outcomes in general. So whether for the individual or for an entire generation. So we always say that our mission is to build a healthier generation. And yeah, I mean, I think what was so interesting, obviously we know kind of where the food system is today, and we realized that there was such innovation needed, particularly in the category of baby, in terms of, really focusing on foods that are nutrient dense, that are, really built for the massive needs that a child has during this period. And so at the end of the day, when we kind of stepped back, we realized this wasn't about just replacing a product on the shelf.
Right.
It really was a question of what should the future food be.
So it's one thing to go from an idea, Evelyn, to actually building a company, Angela. So I'm wondering, Angela, how you then take that idea and you find the farmers to partner with. You find the way to produce it. And look, we're talking baby food here. I mean, there's little room for error, right? You can't get a contaminant in there. I mean, we know what happens if God forbid that were to happen with something that we were to give our children, Angela.
Yeah, absolutely. I mean, one of the things we did really early on was bring in some A-list people to our team. So we brought over a COO from Beyond Meat who built up their entire supply chain, their manufacturing, and we knew that was really important internally to do the same thing. I mean, again, to your point, safety is our number one concern. It's always our number one priority. And so we've always focused on quality control and around who our suppliers are and how much testing we can do. So we do weekly testing as well as seasonal testing on suppliers. We're testing our finished goods as well as our product beforehand. I mean, we are laser focused on making sure that this is the safest and best products for children.
All right, we're going to come back with Evelyn Roosley and Angela Sutherland. They're the co-founders of Yumi, and they're joining us on the phone from Miami and LA. But I feel like, Tim, it speaks to a bigger, broader thing. I've been reading a lot of stuff in the New York Times. It's just about the importance of your gut health and what you eat and what it does to your brain and just your overall health. And we've just got to lean in for every age on this.
Yeah, exactly. Hey, when we come back, I want to hear more about how the company's sales strategy works. direct-to-consumer, and we'll get into all that and more with the co-founders of Yumi.
All right, let's get back to world and national news. A lot going on. Let's head to Nancy Lyons. She's in D.C. Hey, Nance.
Thanks, Carol. Defense Secretary Lloyd Austin is putting 8,500 U.S. troops on heightened alert in case they're needed to boost NATO forces. That's if Russia invades Ukraine. Pentagon spokesperson John Kirby confirmed the order today.
The bulk of the troops I'm talking about today are intended for the NATO response force, the vast majority of them. And that response force can only be activated by the alliance. It hasn't been. It is our contribution to the response force, and we want to make sure that they're ready to go.
John Kirby says there is still time and space for diplomacy. President Biden discussed this situation this afternoon with European leaders. Well, the world might just be emerging from the global pandemic health emergency, but health experts warn not to move too quickly. Bloomberg's Amy Morris reports.
The World Health Organization is warning that conditions are ideal for more coronavirus variants to emerge. And while the pandemic emergency might end this year, it is still dangerous to assume that we are, quote, in the end game. Director General Tedros Adhanom Ghebreyesus says there are different scenarios for how this could play out, and he says the world will be living with COVID for the foreseeable future, and that we just need to learn how to manage it. In Washington, I'm Amy Morris, Bloomberg Radio.
The world's biggest and most powerful space telescope has reached its final destination, 1 million miles away. NASA's James Webb Space Telescope fired its rocket thrusters today, a month after launching on its quest to behold the dawn of the universe. The mirrors of the telescope still need to be aligned before observations can start in June. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. So a couple stories, just kind of fun. We don't really have water coolers anymore, but I feel like these are the things
we have water fountains, so you can't stand around and talk around them.
Right. Socially distanced.
You're like, excuse me, put your mask back on. Get away from me.
Or like, oh, you just used it? Yeah, I'm not going to go there. And we really are very careful around here. But these are the kind of stories you would talk about. So there's a story on the Bloomberg. Fund managers with a chartered financial analyst qualification, the CFA, are less likely to perform well over long time periods than those who haven't taken the famously tough exams.
You know what I feel like I'm reading? I feel like I'm reading a study about investing in ETFs that you follow index funds versus like a managed portfolio that on average the data show that you're not going to outperform.
It's really kind of funny. My brain hurt with that. Researchers looked at the careers of more than 6,000 managers and found that persistent performance was more likely in portfolio managers without a CFA charter, and experience in the market was more closely aligned with a manager's skill.
Okay, so here's what Andrew Clare, professor at Bayes Business School at City University of London, said in an interview. Quote, some of the more experienced guys probably don't have the CFA designation because they're older. So if you could imagine that CFA designation is kind of a proxy for not inexperienced, but less experienced managers. Okay, so it sounds like what's going on is it's a function of where someone is in their career. And people who are looking to get into the industry see the CFA, which, by the way, is a very difficult thing to do.
Yeah, several levels.
Very, very difficult. They see that as a way to get into the industry. But those who are older, more experienced, did not necessarily go through it that way. They have the experience.
I'm done with this one. I'm getting to this next story.
Cool.
Okay, New Jersey is the worst U.S. state to retire in, according to a new ranking, with Mississippi and New York rounding out the bottom of the list.
Sorry, Carol, your home state.
No surprise. Biggest factor in the ranking was that New Jersey and New York were the two least affordable U.S. states to live in, according to a survey released by Wallet Hub.
Interesting. California's not in that bad of a place. Florida, by the way, it's in a good spot. We knew that.
Affordability.
Yeah.
People move where it's cheaper when you get older. All right, you're listening to Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business.
From Bloomberg World Headquarters, I'm Charlie Pellet. The IBM shares up today right now by 5.1%. IBM out with revenue that beat analyst estimates, lifted by strong demand in its software unit, which includes IBM's hybrid cloud offerings, signaling that the company's efforts to transform the 110-year-old tech giant are bearing fruit. Again, IBM up right now by 5.1%. The Dow, the S&P, NASDAQ, a massive reversal there. At one point, we saw a spectacular drop of more than 1,100 points, followed up by a more spectacular rebound. The Dow ended the day higher by 99 points. Dip buyers coming into the market. S&P up 12, a gain of 0.3%. The Dow, by the way, today up by 0.3. NASDAQ up 86, higher by 0.6%. 10-year yield 1.77%. Spot gold up $8 the ounce, higher by 0.4% to $18.43. West Texas Intermediate crude down 1.3%, $84.01 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Well, let's get right back to our next guests, Evelyn Roosley and Angela Sutherland. They're the co-founders of Yumi. They join us on the phone from Miami and Los Angeles. Angela, I want to talk a little bit about sales strategy here and price. I mean, this is your direct-to-consumer, right?
Yes, that's correct.
So in order to actually even see the prices, you have to log in and create some sort of plan. How much does it cost to get a baby on the Yumi plan?
The average price is around $4 a jar.
And there's 7 different stages that I see. So to help us understand how that
it all
works.
works.
Yeah.
Oh, of course. So we're weekly delivery. You can get a small box, a medium box, or a large box, which is 1 a day, a 2 a day, or a 3 a day. We average around like $4 a jar, depending obviously on the size and how, like, the frequency of you're getting it, but that's sort of how it works. Sorry, Evelyn.
Oh, yeah, and our most common plan is actually our milestone plan. So we actually, a big part of our service is the personalization aspect. So, you know, parents will tell us a bit about their kids, their stage of development. And so what we're providing to families is not just, you know, food, a more convenient option, which it is, but actually food that's also tailored to their age, stage of development. So, for example, your kid at 6 months, their iron stores are naturally depleted. And so that's a really common time when people are transitioning to solid. So we'll send you a box of food and we'll highlight the meals that are high in iron. So not only is it, you know, personalized products and meals that come in the box, but also personalized content. And so we've always thought that, you know, what we are ultimately delivering is more than just the product off the shelf, right? It really is about product and context and helping parents connect the dots between their kids' nutrition and what they're feeding them and their future health outcomes. It was actually really interesting in the beginning when we were starting Yumi and going out to investors. A lot of investors told us, like, are you going to get parents to care about folate? And, you know, we've always thought that the future of food is truly functional. It is pharma. It is essentially that long kind of awaited promise of, like, let food be thy medicine. And I think as a generation, we're increasingly at least more open to that messaging, right? And so especially this generation of parents. So, you know, that's actually a big part of the service, is this idea that it is kind of like we're a coach. We're guiding you through this probably pretty stressful part of your life.
Yes. Yeah, I can certainly relate to that. Hey, Angela, I'm wondering how you grow here, because I can just go to the website. I can type in Arlo's birthday. He's just a little over 3 years old, and it serves me up a plan. And I'm at stage 7 already because he's 36 months old. What's the plan to grow beyond 36 months right now?
Yeah, I mean, that's a great question. We've already started offering new lines. So we have new lines of vitamins. We call our multivitamin vitamins. We use entirely plant and fruit-based nutrition, so nothing synthetic. What that does is it allows us to be 100% bioavailable. So unlike synthetic vitamins, you can actually process this completely. And so that's already giving us, like, older kids and, you know, toddlers, teenagers. I'm starting to, like, see a lot of traction there. We have already sold out our first run of vitamins. So that can, like, you know, extend to different ages.
How are you guys coming up with, it's really fascinating, your website. There's a lot of information there, and it talks about your chefs who are involved in it, Evelyn. So how do you guys continue to innovate, find new products? We know kids can be finicky, so lots of different choices are always good. How do you kind of create your community? Because it sounds like it's outreach, whether it's in the medical front and nutritionists or chefs. How are you creating that community? What are you looking for?
Yeah, and I think when you're asking around product development, we always let the science lead, right? Which is why we think about how bioavailable ingredients will be if we're to create a multivitamin gummy. But it's a combination, right? It is kind of building it as a movement. It's listening to what our families are saying. And we realized a lot of families also during the pandemic, as they were looking at their medicine cabinets, they were really anxious around how clean those ingredients were, how clean their medicine cabinet was as they were looking to supplement around extra vitamin D and things like that. And so, when we think about the army that you build, it is finding the right, scientists and working, we're working on clinical studies. We're working very closely with many parts of academia. And it's also, thinking about that food is also a celebration, right? Which is why we partner with chefs, as you mentioned. So we partner with James Beard award-winning chefs, these incredible cultural leaders. And, because of course, food should be functional, it should be grounded in science, but food also equals love. I think Angela and I both come from families. My parents are from Indonesia, and there's a lot of love associated. Your parents may not say that they love you, but they'll put so much love in food. And my favorite memories are with my grandmother cooking as a kid. Yeah. So it's kind of all of that, right? This is a very important introduction period.
It's really fun to look through the products. Angela, we are Bloomberg, and so we love getting into the nitty-gritty of a company, startup or otherwise, in terms of growth. So talk to us about how much you've been growing in terms of top and bottom line. Are you guys profitable? And I'm just curious about market share, because there are some big established players out there. What are you seeing on that front?
Yeah, we feed now 3% of babies born in America. So in terms of market share, we're getting as high as 10% in certain markets. We've grown exponentially in the past few years, really hitting huge scale. But what I think is really amazing is how big this market really is. It's bigger than dog food. So you have this early childhood nutrition category that is much, much bigger than a lot of people really understand.
Right.
And so I think what's really exciting is being able to crack that.
Are you profitable, Angela?
We can't comment on that yet as a private company, but certainly we've been leaning into growth and scaling business.
And how much, Evelyn, in terms of growth of revenues, what are you guys seeing?
Yeah, as Angela mentioned, we've grown considerably, especially in the last 2-3 years. We've been national since 2019, and so really it went from that kind of the floor of that to essentially 3% of babies. So the growth has been quite extraordinary, specifically in the last 3 years.
Well, cool stuff. Just looking at the website, and you have so much there, and it is really fascinating to see the community and to continue to increase the offerings. Tim?
Yeah.
Make it Arlo.
I know. It actually would make my life a lot easier because we wouldn't have to decide what to feed him every night.
There's lots of choices.
Yeah.
Guys, thank you so much. Stay in touch. We'd love to know as you continue to add and grow. Come touch base with us again. Evelyn Roosley and Angela Sutherland, co-founders of Yumi, on the phone in LA and Miami.
It's the type of thing where I'm thanks guys for joining us.
Thanks.
So, you kind of snack on your kids' food all the time, right?
Oh my gosh, right? Don't you see the parents who pull out the baby food and they start feeding their kids and then they're eating it?
It's just food.
I remember a brother who used to do that when his daughter. Folks, one day down, a lot to come. Sound On with Joe Matthew coming up. All the news out of Washington. We've got a Fed meeting on Wednesday. We've got lots to come. For Tim Stanovic, I'm Carol Masser. This is Bloomberg.